and welcome to the Thought Leap. Now, there is a gush of liquidity in the equity markets across the globe and therefore a rush for the IPO markets as well. Airbnb, DoorDash, Snowflake are some of those multi-billion-dollar listings in the US, and the Indian companies do not want to miss this crazy train. So global direct listing of Indian companies has already got a cabinet nod, and we are awaiting the final regulations. Now, this is the hot topic of discussion on the show today, and we are joined by Alexandre Ibrahim, straight from New York Stock Exchange, and we have Cyril Shroff from Cyril Amarchand Mangal Das. Thank you so much, gentlemen, for joining us on CNBC-TV18. Alex, it's snowing there and it's raining IPOs in the US markets. Well, that's the gravy train that the Indian companies want to capture. Now, what is the opportunity that they are looking at, and what are the advantages of listing in the US or say in NYSE?
Yeah, no, thank you. Thanks for being here. It's a pleasure to join my colleague Cyril in this event and be here with CNBC. The market has been extremely strong this year in the U.S. capital markets. We are very excited what we saw in terms of IPOs, how those companies perform post-IPOs and the amount of liquidity that we're seeing here. What's very important to say is that this liquidity and this amazing market that we experience right now is open for companies from around the world. We saw many companies from China, Latin America, and Europe, Canada, in addition, of course, to the U.S. market, coming to the U.S. and raising capital. So really, those companies, they are tapping to this massive pool of liquidity for many different reasons. And the number one reason that we see is access to liquidity. As you know, and as you mentioned, lots of liquidity in the public markets in the U.S. This is a great opportunity for companies to raise capital, but also companies come to the U.S. market because they want to diversify their shareholder base. They want to have access to small retail investors. They want to have access to large institutional investors, and also increase visibility. When you're listed in the U.S., you are in a global platform. You can tell your message not only for investors, but also for potential users of your platform, potential partners, potential employees that you're trying to target. So the whole ecosystem is extremely vibrant. And this year has been a wonderful year for companies to raise capital, in spite of course, of the horrific pandemic that we experience right now.
Right, Alex, you enumerated a lot of reasons why the Indian companies would like to go for a global listing, and here we call it a global direct listing because a lot of companies are hoping to list only in the US or globally, and they may or may not be listed here in India. So that's the difference. That's what they're trying to capture at the moment, and that's the opportunity that the cabinet has approved and the regulatory changes may bring about. Now, a few other reasons, Cyril Shroff, because of which the Indian companies want to go overseas is also the new pool of investors, larger pool of investors. We have seen valuations being rich, ESG really backing the renewable space, the sustainable space as well, and on top of all of that, the profiling and also achieving the American dream of the companies. What are the milestones that are really remaining for the Indian companies to go for global direct listing? And you were part of the committee for the framework of this. So how ready are we?
Thanks, Nisha. And this is a very exciting topic. If I can just step back for a second as to this proposal, I think really is the final act in the globalization of our corporates in the capital markets. The journey began in the early 90s with the first GDR issue. Then there were many of them. Then the ADR, and then in the early 2000s there was the IDR, where Standard Chartered Bank listed on the Indian exchange. You can think of it as a reverse GDR on an Indian exchange. And this is the final frontier because what it does is that it strips away the intermediate instrument of a DR or depository receipt, and you have directly the underlying share, which opens up a host of challenges and issues. And they really fall in three buckets. Firstly, the really clearing the regulatory path for making an issue. Second, once the issue is done, there is a lot of what I call plumbing in terms of how do you hold securities, what is the custody arrangement, how do you transfer securities, etc. And the third big bucket is taxation. Now, the SEBI committee, on which I was a part of in 2018, recommended that this instrument should go forward and made some suggestions, but the matter is now pending with the government. The three big things that are expected for this to happen: firstly, we need an MOF scheme or notification, which is being worked on for a while. The second big thing that we need is going to be tax changes. Now, whether they're legislative or rule-based has to be seen. And the third is a lot of subsidiary changes to be made in a bunch of acts like the Companies Act or Depositories Act or PMLA, FEMA, etc. The Companies Act change has already been made in the Companies Amendment Act of 2020, where the fact that such an issue can take place and some notifications will be done, that has been provided for. But what we're really waiting for with bated breath is the MOF scheme, and it is when that button is pressed that the ball will start rolling. Obviously, a lot more is required, but that's what we are all waiting for.
That's right, and the fine print will really define how soon some of the companies can be IPO ready overseas as well. But Alex, I want to understand, you're part of an exchange. It's also widening of business as more and more companies make a beeline for the IPO, and there have been many successes that we have seen despite the pandemic situation. In fact, certain spaces have been given a thrust. What is the traction that you are seeing from the investor community that you haven't seen before?
If we go back in the beginning of the pandemic, we thought the market was going to perform horribly this year. We saw companies talking to us right around March. We're going to wait. We're going to tap the markets in 2021 when things slow down, when things are in a better position. But it was completely opposite. We're starting to see SPACs little by little come to the market. Suddenly we saw biotech companies and then this huge wave of technology companies. But what's very interesting, what support all this infrastructure in spite of, as I said earlier, the coronavirus pandemic, was very low interest rates in the U.S. capital markets, people looking for opportunities. And they saw these great companies going public, companies actually, the prices of those shares perform extremely well. And we saw not only institutional investors participate in the market, very large funds, but we saw a lot of retail. John and Mary, who lives in Miami, Oklahoma City, getting to the market, participating in those transactions. In fact, a few weeks ago, we conducted a very large transaction from China. And when I was talking to a banker post-transaction, and he indicated to me that even retail investors in the U.S. participated on the deal. So yes, it has become very democratized, and we're seeing a huge wave of retail participation in the U.S. capital markets.
That's right, Alex, and that's really expanding the pie of the global markets as well. But Cyril, Shroff, you were talking about the regulatory challenges and the regulatory frameworks and the milestones that we need to reach, and we still have to see the fine print. But apart from that, how is the market chatter in terms of the preparedness of Indian companies when it comes to global direct listing, and how much is the interest level that you are viewing from your end?
A couple of points. So a direct listing is not for everyone, because certain sectors, I think, will be more amenable to it than others. And it's not as if the Indian markets are in a bad shape. I mean, they are very vibrant. Look at the IPO market just now. There are massive blockbuster deals happening. So it's a very vibrant market here. But sectors, I think, which are amenable will include technology, e-commerce, healthcare. I think these are some of the three obvious ones. So interest levels are very high. But I would say the preparatory levels or preparation levels are low to moderate. And that's natural because the guidelines haven't come out yet. I mean, unless the ball has been bowled by the government, no batsman is going to swing his bat to sort of hit a run. So the preparedness, I think, will happen. But there is extremely high level of desire in these sectors to make it happen. And I think we will continue to sort of evaluate. I think companies which are looking to raise capital or where private equity investors are looking for an exit will continue to look at both these options very carefully, an overseas listing or an Indian listing as well, because I mean, both these options are viable in their own way. And there are many topics. I mean, just to name the top 4 or 5 topics on which preparation requires to be done before you can make this life-changing event. One is, of course, you've got to sort of sharpen and clean up your business model, your corporate structure, including things like your articles of agreement, association and shareholders agreements and all that. There's a lot of diligence preparation that has to be done, governance and board composition, and getting your accounts ready. Now, these are all massive things. So from the date you decide to do something, you should look at it as at least a 9 to 12 month process.
That's right. It's a long process. But Alex, how are you seeing the interest level coming in from the foreign companies? Is it like better than we have ever seen before?
Yeah, we have an incredible franchise of non-U.S. companies listed on the NYSE. We have 520 companies represented by 47 countries, very diversified. We have companies in the oil and gas space, financials, but the majority of companies that actually coming to the U.S. capital markets and listing on the NYSE in the last 5 years have been technology, healthcare. So we're very excited about the number of companies that are coming. And this year in particular, when you look at our success of attracting companies from the outside the U.S., we had massive transactions out of China. We have companies listing from Canada, companies listed even from the United Arab Emirates, which is very unusual. You don't see this type of deals in the U.S. capital markets. So yeah, very excited, very good year for capital raising. And as I said earlier, more and more non-U.S. companies reaching our platform, raising capital, and actually being very successful. Just look at the share price of some of those companies, how they have performed.
Right, Alex. So it's not just India, but various other countries that you mentioned have been making their way to the U.S. markets for a global listing, for a U.S. listing. All right, Alex, as well as Cyril, Shroff, hold your thoughts there. We'll slip into a short breather on the Thought League, but there are various dimensions to global direct listing of Indian companies, and we'll touch base on those ones and get some insights from our speakers on the other side of the break. So stay tuned. Welcome back. You're watching the Thought League, and we are discussing the global direct listings by the Indian companies. Now, Alex, you were talking about the various countries which are quite excited and making their way to the U.S. market for an IPO, and many of them have seen successes as well. I wanted to also get your understanding on the themes as well as the sectors which are gaining most amount of traction.
Yes. The sectors that we're seeing companies coming to the U.S. capital market, the sectors that are seeing, I would say, larger representation is technology or tech-related companies. We have seen quite a few companies this year in the fintech space, e-commerce, also tech ed, education tech. So these are subsectors with technology. There are actually companies coming to the U.S. capital markets and raising capital and receiving very strong support by U.S. and global investors. When you look at 2021, we believe there will be a continuation of those sectors, but I would add also healthcare. We have already we have a company already public file from Latin America in the healthcare system that's coming to the exchange hopefully next year. But we see others, especially from emerging markets, tapping the U.S. capital markets to raise capital.
That's right. Now, Cyril, Shroff, of course, at various levels you touched upon this topic, that the framework needs to be developed. What about the tax issue? For any global transaction or cross-border transaction, that is the biggest aspect that the companies watch out for.
That's very right, Nisha. Taxation is a very critical issue. And the taxation aspects have to be considered at kind of two stages. First is the stage of the initial transaction and initial listing, which could be the initial issuance as well, as if there is a sale by existing investors like private equity investors who want to sell into the IPO, the taxation as far as they are concerned. So that is stage one. Stage two is later, post-listing, when holder one transfers to holder two and sort of dealings take place on the exchange. What is the tax treatment for the same? And there is, for both these stages, there is both direct tax as well as indirect tax related aspects. There's also a lot of procedural stuff of who will collect the tax, who is accountable, how do you calculate, etc. So there are two theories of how to do this. One theory which I think the market will probably want, or investors will want, is they will want parity with GDRs. Now, GDRs was possible in the early 90s because the law was amended and Section 115AC was added in order to provide for effective tax neutrality of overseas transactions. The other theory is that let it be on par, because it's directly shared, let it be on par with how the tax treatment is on an Indian stock exchange, namely if there is STT or something like that. So this issue hasn't been resolved. I think there's a lot of thinking that is going on, and one of the two paths will have to be chosen. And this is a little bit of a make or break issue, because if the tax treatment is not efficient, it is likely to be a big dampener for investors, both at the initial stage as well as in the secondary market when buyers are acquiring stock. So I think the policy establishment will have to figure this out very sharply and correctly. If they want to think about it in the kind of GDR way, there's a path well trodden, and they might have to, of course, the law will have to be amended to allow that, but that's the way to go. But let's see where that lines up, because I think the kind of intellectual battle is on in the policy establishment at this stage.
And what about the regulatory changes and plumbing that is required probably for the custody and transfer of shares for a global direct listing, Cyril Shroff?
Yeah, very important. Now, what do we mean by plumbing? So it is how will the shares be held through the depository and custody arrangements? How are you going to monitor the ultimate beneficial owner? You know, that's how big an issue that is in the Indian context. How are you going to achieve holding accountability when transfer of shares takes place from one? KYC requirements. What about fungibility in case that happens, where if you're going to allow movement, if the underlying company was listed in India as well, in that situation, how are you going to allow movement of securities between markets? So there is a pile of issues in the business as usual post-listing stage, which we loosely call plumbing. So for that to happen, a number of legislation and rules will have to be amended, including the Depositories Act. I think FEMA might have to be changed. You might have to think of which sections of the Companies Act will be disapplied, stuff like that. But it is relatively a sort of a simpler issue compared to the issues that we just discussed. And a lot of contracting, special contracting with the stakeholders, depository, custodian, issuer, registrar, all of that will solve many of these issues.
That's right.
And of course, the exchange. Of course, Alex will be a big part of that equation, because the securities, when listed, would be listed on an international exchange such as Alex's exchange.
What has been the experience of the foreign stock exchanges when it comes to the foreign listed companies? There have been many Indian companies who are already listed overseas. There's many Chinese companies, and now you're seeing traction from many other countries as well. How has been the experience?
Those companies, they have to, first of all, they have to be ready to be in the U.S. capital markets. This is not for every company. There are markets, like Cyril mentioned, the Indian market is very deep, the Brazilian market is very deep. There is a very strong market in China or in Russia. But companies coming to the U.S., they have to have in their minds, they have to realize that once I make this decision, I will have to follow what my peers are doing. So they have to have a commitment by the management team, the board, that they will be a publicly traded company and they will have to behave as such in the U.S. market.
At least in India, we have seen, Alex, that the market regulator and the government has moved towards taking many measures for making the Indian markets very robust and at par with the global standards. Cyril Shroff, last word to you. When it comes to the corporate governance standards as well as compliance with the SEC regulations and overseas regulations, what is the preparedness for the Indian companies?
So let's be clear firstly of who we are talking about. We are talking about, in the context of today's topic, we are talking about companies which are unlisted in India but would be proposed to be listed in the US, which is the SEC question. The Indian issuer who will go there would be characterized as what's called a foreign private issuer. And a foreign private issuer has a different regime, so say, from a domestic the US issuer as well, because on many things, except on one or two things like the composition of the audit committee, the US laws kind of throw you back to the home country. So the US would be, say, the host country for the listing, and the Indian law, which is the home country's law. So the US regulatory and policy framework for most things will look for the underlying laws of India.
That's right.
And there are also exemptions for emerging growth companies for a period of 5 years as well. So it's not so onerous. So that's one part. The second part is that on the Indian side, our regulations have evolved tremendously over the last 2 decades in terms of corporate governance, the number of committees, including the Kotak committee, and before that the Murthy committee, etc. Most of the likely issuers also have a lot of foreign investors, so they are prepared.
That's right.
So personally, I don't see there to be such a big gap in terms of how Indian companies would face US corporate governance or NYSE standards. With barring one or two differences, I think they're ready.
All right. So not big cultural shock when it comes to the corporate governance as well as regulatory standards. Thank you so much, Cyril Shroff, as well as Alexandre Ibrahim, for joining us on this very riveting conversation on global direct listings of Indian companies. So clearly we see this particular setup really building. Direct foreign listing will be a game changer for the Indian companies, especially from the startup space. But the regulations and tax laws need a proper framework to really make it conducive for Indian companies to tap the global wealth to finally achieve the scale and size which puts data-rich Indian companies ahead of the global tech giants, and also finally realize the American dream. Thanks so much for tuning in to the Thought League.